We are joined by Meghan Graper, who is global co-head of the investment grade syndicate team at Barclays, and Cam Harvey, who's professor of finance at Duke University. Rick and Steve, of course, are still here with us. Why don't we go ahead and start with you, Meghan? What are you thinking after you see this number, after you start to try and get into the head of the Feds, the Fed people who are meeting, I should call them? What do you take away from this?
Yeah, I mean, I think Steve's exactly right. I think today's data is just another illustration that we're entering a far more complicated phase of this cycle, with the market and policymakers, I think, clearly at odds over the path of rates. I think as we look to tomorrow, 25 is a foregone conclusion, but I think the Fed has not only their credibility on the line, they're also fighting with this soft landing hope that I think is still going exceptionally strong. We don't think Powell blinks in his commentary tomorrow. I think he's going to look to buy optionality. I think he's going to reiterate sort of a willingness to maintain a more restrictive stance, even as he acknowledges some of the accumulating evidence of a slowing economy. So I think he looks to downshift. I think he looks to do that without a reduction of this 5% terminal rate that they highlighted at the last meeting. And I think he tries to do that without the further tightening or easing of financial conditions, I should say.
Rick, let me jump to you real quickly, just as probably the most market-oriented person out of this grouping. If that's the case, if Powell doesn't blink tomorrow, if he stands pat, what's the market's reaction, you think?
When you say stand pat, doesn't blink tomorrow, what do you mean? He comes in with a 25 or he doesn't do anything?
With 25, but then he talks pretty tough about it, doesn't relax, doesn't let people think that they're going to let up anytime soon.
And I think he explicitly counters any expectation of a near-term dovish policy turn.
You know, I don't think that the market is necessarily conforming to the question you asked, and I'll explain why. When I watch a baseball game, I don't necessarily pay more attention to the strategy of the manager or the fact that the umpires are calling the game, balls and strikes and plays. I look at the game for what it is, and there are many investors that are looking at the markets and not spending an over amount of time trying to dissect and get in the head of Fed Powell or any of the other people on the Fed, because in many ways their behavior is counterintuitive and their past history is not successful if your litmus test is making money.
Right.
I think there are many investors out there that look at what's going on in the market, they see inflation coming down, and they say, okay, let's be macro and easy about this. What's really changed from pre to post-COVID? Really? Two things. Over half the buildings in Chicago are still less than 40% filled, okay? And there's about 7 or 8 million people that, for whatever reason, aren't coming back to the workforce. Now, if you can square those two things, you probably find the answer to your question without a preponderance of time trying to get in Powell's head.
I love this. I mean, Rick, you just laid out what the market is saying every day when they ignore what the Fed does, ignore what Jay Powell and company have to say. They're looking through it and looking at their own data. And Cam, maybe that's the next question. We talk about how the Fed is data dependent, but it's dependent on different data than the market. A lot of market participants are watching.
Well, actually, I think that they look at the regular data. So obviously they'll look at today's announcement. But my opinion is that I like what Steve said about compensating for the earlier mistake, but I think that they're compensating for the earlier mistake of being so late, calling inflation transitory, with another mistake. So if you look at the data, if you look at the CPI data, there's no inflation over the last 6 months. If you look at money supply, which was a major driver of inflation, it is down 1.3%, and it's the first year-over-year decline since 1938. So what I am worried about is the continual push, even 25 basis points. In my opinion, the market has got comfortable with 25 as the least worst scenario. In my opinion, the Fed should stand down. The inflation, I think, is under control. There could be idiosyncratic inflation, but the main thing of raising the rates, cooling the housing market, that's job done, and it's time to stand down.